Welcome back. Welcome to The Open on BNN Bloomberg. Canada's mortgage market is dealing with the double whammy of a rising rate environment and the after effects of tightening of housing rules in Canada. It's something our next guest watches closely. Andrew Moor is the president and CEO of Equitable Bank and joins us now with more on his company's latest earnings and his outlook for the industry. Andrew, welcome back to The Open. Thanks for joining us.
Thanks for having me, John.
Let's talk a little bit about what's happening with your business as it pertains to some of the stories we talk about every day here. In other words, changes to mortgage rules at the beginning of this year, the possibility of rates impacting the mortgage market. What are you seeing in your business right now?
Well, I think in amongst all this noise, one thing that's forgotten is that actually in Canada today, mortgage arrears rates and defaults are actually the lowest level recorded since records begun. So that's sort of something we have to keep in mind. Certainly, we've seen a slowing in origination, so that is new mortgages being taken out in the first quarter.
Yeah.
Although we're seeing the Q2 looks much stronger already, and we would expect that these changes take about 6 months to go through the market. This is a big change, so maybe it take 9 months before we really understand the full impact of B20.
9 months. When you see all those surveys, and a lot of time they, quite frankly, come out from different banks across the country about Canadians being deep in debt and just one little change impacting their situation. It sounds to me from what you're saying, in reality, we're not seeing a lot of people fall into that icky situation.
We're seeing very few people falling into an icky situation. I do believe, and then the Bank of Canada is quite clear about this, that today the Canadian economy is more sensitive to interest rates as a result of the higher levels of consumer debt. So you might see consumer spending slow long before you'd ever see any challenges in the mortgage market.
Yeah, I remember you talking about that before. That's the initial impact area to watch, is how much people are spending.
That's exactly right. And I think when you hear the governor of the bank speaking, it's very clear that the bank is sensitive to that issue.
What about how it's impacting? I mean, first of all, it's one thing for the Bank of Canada to raise interest rates. It's another for the U.S. Federal Reserve to raise interest rates, and then for that to be reflected in the bond market and ultimately in the Canadian mortgage market. We have seen some banks aggressively trying to offer good deals on variable mortgages. We were talking about Bank of Montreal doing that over the last week or so, getting them away from fixed to variable. Tell us about that industry trend.
Well, I think it's really the big banks actually catching up with where the market is. So banks like ours tend to fund those kinds of mortgages in the securitization market. We were actually already at the same rates as the Bank of Montreal for a period of time before they came down to match us. So the mortgage brokers have always had that rate, and I think really this is simply a reflection of the larger banks having to catch up with the mortgage broker channel.
How competitive would you say it is right now?
It's competitive, but it's always competitive. People like to lend to Canadians who are buying houses. It's a great area for the banks to be in business, so it's competitive for sure.
What about the demand you're seeing for steady Eddie return investments like GICs and the like? I think we've watched a story in the markets recently about, because, let's look at the U.S. market and the 10-year yield around 3%, all of a sudden are people putting their money in stocks? Are they putting it in the bond market? What do you find in terms of the investor appetite for the investment products that you guys create?
Yeah, I mean, certainly we're seeing higher flows in the GIC markets. So, all of a sudden now you can see GICs over 3%, and that starts to become more interesting to people. So with the general aggregate flows, and in particular for Equitable, we've launched EQ Bank GIC, so directly around digital platforms, and we're seeing very strong uptake there as well.
Okay, so you came out with your quarterly results. It sounds like you're not too concerned about that worst case scenario, despite the fact that a lot of Canadians are deep in debt. Your stock price is down this year. I think it's lost about a fifth of its value. The financials as a group are down this year, but there are a few banks that have managed positive territory this year. Why do you think the market has been less favorable towards your shares?
Well, I think there is this overwhelming concern about housing, and Equitable's seen as that in that way. Equitable Bank is seen in that way by many people. I generally am much more confident about our future. We've positioned ourselves as Canada's challenger bank. We've got a state-of-the-art digital stack. So we're really well positioned to adapt to the market as it changes, the banking market as a whole. We've also just recently launched a reverse mortgage product. So we're one of two banks in Canada that attacking or providing services to the seniors market, which we see as likely going to grow over the next few years.
The folks at Bloomberg did an interview with Steve Eisman, who is well known as one of the key characters in the book The Big Short by Michael Lewis,
right,
as somebody who bet against the subprime mortgage market. And he's come out with a new call. He's very cautious on a lot of financials around the world, but he is suggesting that shorting the Canadian banks is a good strategy right now. What do you think about that?
I think the Canadian banks have proven themselves to be strong, sensible players over many years. I'd bet over 10 years that that'll be proved to be a wrong call.
And I mean, we've talked to you in the past about the very vocal comments that Mark Cohodes, who had been betting against your company, had made about your business model. I remember it was like a year ago you said something like, people have an interest in making our company seem weaker than it is. How do you feel today about the investment thesis around your business?
Well, I think our business is incredibly strong. We're one of a very small number of banks in Canada, and we're positioned for the future of banking. So as open banking emerges, as technology changes, this is going to be a very strong institution, and I'm confident that our team have got everything they need to make that happen.
Outside of the housing market, when you talk about the lending environment right now, especially, let's say, if consumers are not going to the mall as much, how is that impacting where you lend money right now?
Well, we lend a lot in areas outside of housing, so retirement homes, apartment buildings, malls, strip malls, catering to a local clientele, and we've seen that business being very strong. In fact, we had one of the strongest quarters ever in this current quarter in lending in that business. So yeah, sure, the economy is changing. I think we're less confident about lending to retail or large malls, but there's plenty of other places to be lending money against real estate.
Let me talk about the sector that everybody seems interested in these days, which is cannabis. You saw a major deal in that sector today, Aurora and MedRelief. You saw Canopy, the largest player, say that they're hoping to list on the New York Stock Exchange. Do you list any cannabis-related companies at this point?
We're not involved in that sector at all, and in fact, we're taking a somewhat cautious approach to it. I think it's for other larger lenders and so on to really sort of understand as the regulation evolves, and then we'll follow as it becomes a more normal part of Canadian society. What
would be the key concern you've had as a lender? Like, theoretically, you could lend to this group, but you've chosen not to?
Yeah, I think theoretically we could do it. Well, I think there are issues still with in the United States. This is illegal federally, and there are some concerns about if you want to access the U.S. Fed, and you're dealing with a law that's illegal in the United States that could limit your access. So for a small institution like us, that's not a risk we'd want to be taking. Larger banks that can really get their arms around the legal niceties can probably be more aggressive than we would want to be in that area.
All right, Andrew, thanks for the update on the business.
Great, thank you, John.
Andrew Moor, President and CEO of Equitable Bank, joining us.